We've got Rajiv Lal, Managing Director and Chief Executive Officer at IDFC, joining us on the show today to talk to us about his company's plans to launch an IDF. Rajiv, if you could take us through the details of this fund that you plan.
Right, so we are planning a slightly different kind of fund. This is an infrastructure debt fund in a mutual fund structure. The one that Citi and ICICI came out with is actually an IDF in an NBFC structure. So the important difference between the two structures is that the mutual fund structure, which is the one we are pursuing, allows us to actually pursue a much greater variety of assets than the NBFC structure. In the NBFC structure, the only assets that you can book in that company are post-COD projects under a PPP concession. Whereas here we have the option to mix and match a whole portfolio of our infrastructure assets, which could be post-COD cash generating, but could also be earlier stage projects as well. So it gives us a wider footprint in terms of the asset opportunity set.
Sure. So essentially then you would, this IDF would go through IDFC asset management, would that be right?
Correct. So this we are introducing, we filed the prospectus with SEBI a couple of days ago. So it will be introduced as a scheme of IDFC mutual fund. And the idea would be to market this to investors both domestically but eventually also from overseas, institutional as well as high net worth individuals. So we are looking for domestic and offshore investors, institutional as well as from the high net worth community. So it should, we expect, be an interesting and important broadening of the fixed income paper that is available to the market through a mutual fund format. It allows us to connect with a wider array and community of investors to help develop fixed income markets targeted at infrastructure development.
Sure. And Rajiv, is there a number you have in mind in terms of the target corpus you'd ideally like to raise?
Yeah, I think over time this thing could become really quite large. We are expecting this to ramp up to over 5,000 crores, and we will have to tweak the design of the product as we go along. But it is our sense that there is a significant unmet demand for fixed income product with relatively decent returns, higher returns, superior returns, especially amongst the high net worth community, both domestically and potentially also offshore. So that is the particular investor segment that we are after. We are trying to match their unsated demand with the supply of good quality paper targeted in infrastructure.
Afternoon, Rajiv. Now, how will the infrastructure debt fund that you're looking to launch be operated in terms of investments?
So for us it was a relatively easy thing to do, and this is quite important because of the huge amount of expertise and knowledge that sits in IDFC. There will be a collaborative arrangement between IDFC Mutual Fund and IDFC to actually identify these assets. So it will be an advisory relationship between IDFC Project Finance and IDFC Mutual Fund. IDFC Mutual Fund will be the actual asset manager of these assets, and some of the expertise and the advice will come from IDFC, the parent. So since as a group we are focused principally on the infrastructure space, this is a very convenient and effective synergy that we are hoping to exploit between IDFC parent and IDFC Mutual Fund.
Sure. And Rajiv, just looking a little beyond the IDF that you plan to launch, Now, going by the Planning Commission's number that it has put out for the current 5-year plan in terms of the funds required for the infrastructure sector, they've talked about a number to the tune of $1 trillion. Do you believe we're capable of finding all those resources to push through these projects?
I think we are eminently capable of doing it. It's a question of our application and will and focus. I think that if the regulatory environment is perceived to become more stable and a few residual problems that are being confronted by different segments of the infrastructure space are addressed, I think raising money is the least of our problems. So I'm quite confident that we will be able to do it, provided some confidence-enhancing measures are taken to give comfort to long-term investors that India is a stable place long-term to invest in. Stable and predictable.
Sure. Just wanted to deviate then from the infrastructure debt fund and talk about your overall expectations from the RBI in terms of interest rate cuts on the 15th as well as through FY13.
Well, I think in FY13, it's easier to answer the FY13 question because I think over FY13 I do expect interest rates to be cut. Whether they will be cut on March 15th, I don't know. My guess is that what the RBI is signaling is that they have been focused on resolving first and foremost the liquidity shortage in the banking system, which they have done through the CRR cut. Interest rates is a call that I rather suspect is contingent on what the budget looks like. If the budget signals credible consolidation, my guess is that the RBI will feel much more confident about supporting that initiative with a rate cut sooner rather than later.
Sure, and again, just focusing on the budget, Rajiv, do you believe there is a case for allowing banks to be allowed to issue tax-free infrastructure bonds as well?
Yeah, I don't see why not. What is the logic behind tax-free infrastructure bonds? The logic behind that instrument is to attract retail investors that are currently putting their savings in other instruments into some kind of security that is in a targeted fashion utilized by infrastructure. So it should be agnostic as to who issues this paper. Whether an NBFC such as IDFC does it or a bank does it doesn't really matter. The important thing is that the use of the funds must be specifically and transparently allocated towards infrastructure. It's easier to monitor that in a specialized NBFC construct like an infrastructure financing company. It is harder but not impossible to provide that transparency and monitoring in a bank construct as well.
Sure, but allowing banks to issue infrastructure bonds, doesn't it make it that much more difficult for you? You need to compete with them to raise money from retail investors.
Look, I mean, competition is a way of life. We are not afraid of competition. I think the policies should not be formulated on the specific requirements of individual companies. Policies need to be formulated with the wider public purpose in mind. The public purpose, as I've explained, is to find ways of channeling existing savings into infrastructure. So if this is a credible way of doing it, why not?
Rajiv Lal, pleasure speaking with you. Thanks very much for joining in and giving us more details on the infrastructure debt fund as well as your expectations from the RBI in FY13.